Hello and welcome to our webinar on the federal budget changes for 2017. My name's Brenda Hutchinson and I'm the partner of our Superannuation Advisory and Audit Division at TAG Financial Services. The information I'm going to be presenting this morning is general in nature only and should not be acted on without first seeking professional advice. None of the information is going to be a recommendation or advice, so before applying to your particular circumstances, please make sure that you seek professional advice on that basis. So I wanted to just cover very quickly the federal budget and what sort of came out last week, specifically in relation to any superannuation changes. So really this budget was fairly quiet on the superannuation front, which was a great thing considering how many changes there was to the superannuation side of things in last year's budget, which we're obviously still working our way through. So fairly quiet there. So one of the first things that they announced was the penalty unit changes. So when we have clients who breach the legislation and a qualified audit report is prepared, the trustees have a penalty imposed on them. And the penalty system works on a unit system, so there a number of units are applied depending on the nature of the breach. There are a few of the breaches, such as a breach of the in-house asset provisions or the acquisition of assets from members. Some of those much more significant and have much bigger consequences to the fund will have a higher number of units applied to them. Then each unit has a dollar value that applies to it to give the monetary penalty that the trustee is required to pay. So that monetary unit, what they announced in the budget was that that was going to increase from $180 per unit up to $210 per unit. So a fairly significant increase there. Really this type of penalty is to act as a deterrent so that our clients are not breaching the legislation. And don't forget, depending on whether you have a corporate trustee or individual trustees will determine how often that penalty is applied. So if it's a corporate trustee, it will just apply once. If it's an individual trustee, each of the trustees will have that penalty applied to them. The First Home Saver initiative, so they talked about this a number of years ago and it never really got off the ground, but they're going to give it a whirl again. What they're trying to do, and obviously Australia has very high property prices, particularly along the eastern coast and particularly in those capital city sort of areas. What they're looking is to give a sort of financial boost to people coming into the market for the first time. So, there's lots of talks in the media at the moment. If they cut out their avocado toast and their coffees, they might be able to afford a home. So, and this is to help supplement that. So, a bit of a farce as far as, how much that they can save. But we're looking to potentially use the superannuation environment to help provide that financial assistance for the first home owners. Now, this is to be effective from the 1st of July 2017, but obviously it hasn't received royal assent yet, so it hasn't gone through the legislation process, so it may change. As with some of these things, they often get deferred or whatever the case may be, but if it goes through as it currently stands, it's to apply from the 1st of July 2017. So what young people will be allowed to do is contribute a maximum of $15,000 per annum, with a total amount being applied for this First Home Saver grant, if you like, being $30,000. So if they're putting in the full $15,000 per year, they'll only be able to do this for 2 years. If they're not putting in the full $15,000, then they'll, that sort of period will be able to go a bit longer. They will be able to claim a tax deduction for that contribution. So essentially in last year's budget it was announced that the 10% rule was going to be abolished. So that's the rule, is 10% or less of your income from employment income or not. So that rule has effectively been abolished. So someone would be able to claim a tax deduction. So it could be, for a young person, it might be like a salary sacrifice type arrangement. Now, one of the things that they'll need to be very careful of is that it must comply with the current concessional contribution caps. So as of the 1st of July 2017, they're dropping to $25,000. So depending on what their employment income is and that 9.5% super guarantee that's required on their salary and wages will, to a certain degree, impact on, whether they could actually make that full $15,000 for that year. Now, these provisions are applying per person, so it's not as for a couple. So essentially, a couple could contribute up to $60,000 maximum that goes into their superannuation. Now, what the ATO will do, so when that comes to the time that they, want to put a deposit on a home, the ATO will make a calculation of the amount that they'll be able to withdraw from superannuation. So that will take into account some of the earnings that have accrued on that amount that they've saved in there. Now, obviously, they would be well under an age where a condition of release will meet, so I imagine there'll be some sort of forms that they're required to fill out for that condition of release to be satisfied. And as the amount comes out of the superannuation fund, it will be taxed at the member's marginal tax rate, but they will be entitled to a 30% offset on that. Now, one thing that they did mention, a sort of caveat they've put over this, is if one of the couple has already previously bought a home, then neither of the couple is going to be able to use this provision. So it really is for people who are, and particularly if they're part of a couple who are first home buyers and have never purchased property previously. That includes whether they've purchased an investment property or a, principal place of residence previously. Obviously, in last year's budget, there was a lot of changes made to the contribution limits, so and how much you're going to be able to get into superannuation. And now with the 1.6 million total super balance, if you're over that, you're no longer going to be able to put any non-concessional contributions in. So one of the changes that they announced in the budget last week was what they've called a downsizer contribution. Now, this is not starting for just over a year, so to be effective from the 1st of July 2018, and what it's going to allow people to do, people who are over 65 years of age, if they downsize their home, they're going to be able to make essentially a one-off non-concessional contribution, but it won't count towards the non-concessional contribution limits. So in order to qualify for this, they must be over 65 years of age and have owned that main residence for at least 10 years, so 10 or more years. They won't be required to satisfy a work test, so the normal tests that apply for someone who's between 65 and 75 years of age, where they have to work the 40 hours in a 30-day consecutive period, that won't need to be satisfied. We haven't seen yet whether this will apply for people who are over 75 who can't normally make a contribution because it's not counting against the caps or work tests. They may still be able to do it, so that's a bit of a watch this space. As I said, it won't actually count towards the non-concessional contribution caps, but will be treated in the fund like it is a non-concessional contribution, so it will have that tax-free nature to it. And these limits, so it's $300,000 that they can put in one hit, so essentially like our bring forward of a 3-year non-concessional contribution, and it is per person, so a couple could effectively put $600,000 into their superannuation fund after they've downsized their home. With regards to non-arm's length income, it's a proposed that Section 295(550) of the Income Tax Assessment Act 1997 is amended so that the arm's length transactions are really done on a non-arm's length basis. So it's really aimed at tightening restrictions and the ability to use schemes as such to get around the contribution limits. So, it's really going to have a focus on expenses and ensuring that those expenses that are, paid out by the fund are really done on a commercial basis. So really with this new total super balance and the transfer balance cap amounts of 1.6 million, to make sure that if there's transactions going on, not more than market value expenses are coming out to effectively reduce the balances so that you're within those limits. So just making sure that all of those are taken care of as they should be. With regards to the LRBAs and pension caps, this is quite an interesting one. So with our pension caps, our $1.6 million limit, one of the things that they're essentially looking at is, are people going to borrow to get extra money into the superannuation environment and sort of essentially artificially deflate their account balances? So what they were concerned about is that people would withdraw a whole heap of pension balances out of their superannuation fund, bring themselves under the $1.6 million limit, and this would be particularly obviously the case if they're on a full account based pension, bring the balance below the 1.6 and then lend it back as a borrowing. So because you've got the loan there, your net asset sort of position is below that 1.6. So originally when they started talking about this, it was going to be that the whole value of the loan would essentially be added back to the assets of the fund. So that was announced a little while ago. And then the week before budget night, some draft legislation was tabled. And in that draft legislation, it actually talked about that it wouldn't be the full value of the loan that would be added back, but rather the actual repayments that were made every year would, if your pension balance was over the 1.6, you would actually have to commute part of the pension because that repayment would count towards the 1.6 sort of limit. As you can imagine, that would result in a substantial amount of paperwork and stuff to commute pensions every year. So what they were also talking about in that draft legislation, and when they sort of first announced it, that it would only apply to new LRBA arrangements, so ones that were already in existence, this issue wouldn't be counted. When the budget was announced, they've gone essentially back to the total liability would count, and that it will account for all LRBA. So it looks like it's going to be a retrospective. So this is very much a watch this space, because we've got draft legislation that's in conflict with what was announced at the budget. The contribution changes and so forth. So finally, what do you need to be aware of in the lead up to 30 June? Obviously the contribution changes that came through last year. So as of the 1st of July, all our limits are changing. So the 25,000 concessional limit, the 100,000 non-concessional limit, and with your non-concessionals, there's also transitional provisions that apply. So particularly make sure where you've got clients with with salary sacrificed arrangements, with their reduced concessional contribution that they've spoken to their employers. What needs to happen before 30 June? So our pensions, do we need to start pensions? Do we need to turn off transition to retirement pensions? Have a look at those. Have a look at the CGT relief. Is there any opportunities to access the relief? And make sure that we're careful around the decisions regarding CGT relief, because once we make the election, that is going to be irrevocable. So you want to make sure you get that right. So really that was all that we had in the budget as far as superannuation changes. So as I said, a fairly quiet one. So if you've got any questions, please don't hesitate to contact either myself or Jason Roccaselvo, the Senior Manager in the Superannuation Division. You can reach us at brendah@tagfinancial.com.au or jasonr@tagfinancial.com.au, and please link in with both of us on our on the LinkedIn website. Please don't hesitate to join our mailing list. We provide super technical updates, webinars such as this one, and information sessions that you might find relevant. So you can join our mailing list at www.tagfinancial.com.au. And don't forget, we've got our superannuation strategies and updates seminar coming shortly. So we're going to be covering everything that's new in the budget and so forth, particularly with last year's budget as well, because there's obviously a lot of changes. Some of it does need to happen before 30 June, but there's also a lot that needs to be considered afterwards. So, you know, make sure you come along and hear about all the strategies we've got there, our wealth accumulation strategies, our generational planning strategies, as well as exit strategies for, you know, making sure people can get the money out of the fund in the most tax effective way. So the dates of our seminar: Sydney 25th of July, Brisbane on the 27th of July, Melbourne on the 3rd of August, and Adelaide on the 7th of August. Please visit our website at www.tagfinancial.com.au for more details and registration process, and you can also download our app. If you go to the App Store, look under Tag Super Seminar, you'll notice the app has our owl on it like that, so it'll be easy to recognise. There's a lot of detail about the seminar, as well as a link to the registration. We look forward to seeing you all there. Thanks for the time. Until next time, I'm Brenda Hutchinson. Thank you.